The debate around consolidation in the Indian banking sector is certainly not new. What is perhaps new is the expectation that that debate is finally yielding some action. This week, the government announced the merger of Bank of Baroda with Dena Bank and Vijaya Bank. A weak bank comes together with a relatively strong bank and a recovering bank to create the third largest bank in the country. The proposed merger gives us an opportunity to speak of the costs and benefits of consolidation. And joining us for this discussion is Krishnamurthy Subramanian, Associate Professor at the Indian School of Business. Professor Subramanian, thanks so much for joining us here on Bloomberg Quint. Firstly, let me start by asking you a contextual question and then, ask you to highlight some of your deeper thoughts on the issue as well. For the last couple of years, it has been felt that we badly need to get this cleanup of bad loans out of the way. So all energies, whether it's the government, the regulator or the management, should be focused on that. We're now at a stage where at least the stock of bad loans has been adequately perhaps recognized. At this stage, do you think a move towards consolidation, which the government seems to have taken, is appropriate?
I think, that's an excellent question. I don't think that this will really solve the problem of, reducing the stock of bad loans that we have, the residual stock of bad loans that we have. I think the bigger measures have been the bankruptcy code and the NCLT and the dirty dozen that sort of has gone through the NCLT and are going through it. This is more of a long-term measure, is how I foresee. Clearly, Dena Bank has been, I think, in significant, stress. So it's a measure to try and sort of strengthen a weak bank, but my worry is hopefully it does not weaken a strong bank.
On that point, I think so there were two lines of thinking that have been doing the rounds. One is that this was almost sort of a bailout of Dena Bank. We have 11 banks under PCA, Dena Bank being one of them, and it doesn't look like they're improving on their own. So mergers have now become a necessity rather than a reform. Would you lean towards that debate?
Right. Yeah, I think the way to reform these banks has to do with governance. And as I have said, repeatedly, I don't think there has been, significant move on that front. Unless some of the key governance reforms are undertaken, the problems that really trouble these banks, will continue into the future. And so there was no way for Dena Bank to be able to dissociate itself from the troubles that it's facing. So it is effectively a bailout of Dena Bank. There are some advantages that I, foresee, which can come good. I think there is some diversification, certainly in terms of the product segments that they are in and in terms of the geographical segments that they are in. For instance, Vijaya Bank is very strong in the south. You have Dena Bank, which is very strong in the west. And you have, Bank of Baroda, of course, which actually has a pan-India presence, but with, disproportionate impact mostly in the western and central part of India. Also, both Bank of Baroda and Vijaya Bank have very strong retail portfolios, unlike Dena Bank, which does not have a very good retail portfolio. But there is one saving grace in Dena Bank's case, which is that its CASA percentage, the percentage of current accounts and savings accounts, is larger. So there are some advantages. I think, economies of scale and scope, which is typically the reason why you would actually do a merger of banks in the first place, not in a situation of distress as it is now. Those economies of scale and scope are definitely possible, provided the integration of the banks actually is undertaken in a diligent and careful manner.
That's exactly the point, right? I mean, one understands the scale aspect of merger, but that has to play out in various forms, right? Firstly, the merged bank has to have freedom in terms of, say, manpower, adjusting manpower. Here, we know that there is going to be no layoffs. Branches, ATMs. Do you think even that sort of scale thing actually comes into play in public sector banks, where there will be so many restrictions on what you can and cannot do post merger?
See, no, there will be some, because some of the fixed costs that that banks incur in maintaining these ATMs, maintaining the sort of using technology, etc. Those fixed costs will now be spread over a bigger denominator, because you'll have these three banks actually the asset size increasing significantly. So there will be some gains on that part for sure. But I completely agree with you that we are still sort of scringing at the crumbs in this case. Because the bigger gains will really come when you actually implement some of those governance reforms. There are a couple of other worries that I actually should point out. One is, and that's so one has to really look at the actual loan by loan, the portfolio of NPAs that are still sitting in these banks. Because one thing we have to recognize is, when these were three separate banks. Suppose there's a particular borrower which is actually has been marked as an NPA in, let's say, Vijaya Bank's case, but not in the other two. Now with the merger, you can't have that same situation. It will have to be marked as an NPA in both the others as well. And so there will have to be a rationalization. So there will clearly not be a simple addition of the NPA numbers. There will be a change, quite possibly, if there is still some amount of sort of NPAs that are being hidden. It's possible that these NPA numbers will go up because of the rationalization. So there are worries for sure. I also tend to sort of look at the, in a different sphere. Take the Air India-Indian Alliance merger, for instance, which was sort of put down the throat of the managements. And we all know what happened, I think. So that to me remains a worry. I hope that the managements of particularly the healthier banks here, Bank of Baroda and Vijaya, sort of see that there are gains, there are synergies from this, and sort of run with it, and really focus on integration, especially on the employee side and on the technology side. If they're able to do that integration, some of the gains that I've talked about may manifest.
Do these mergers tend to, result in sort of capital saving to some extent? Do you see this one having that benefit? I mean, the government hasn't said that that's one of the reasons why they're going in for it, but one is assuming that they don't want to put more capital into Dena Bank. So how easy is it to, see capital conservation post a merger?
Yeah, I think I just quickly ran some numbers and I looked at it. So Dena Bank's, for instance, the capital adequacy ratio, my numbers suggest it's basically about 8.8%. So it's clearly in stress. In contrast, you have Bank of Baroda and Vijaya Bank, which has actually have in excess of 10%. So together the combined bank will have the capital adequacy numbers will look healthier. And as a result, what may also happen, I think one benefit that should happen is, those customers of Dena Bank, which actually, because of it being under PCA and therefore not able to lend, now that they actually have sort of a little bit of room, they may be able to actually start lending, and that may be something that is. Remember, Dena Bank does have a significant presence in the West, and given that a lot of our economic activity is also concentrated in the West, some benefits can come from that front. But I do agree with you that capital, what you're really doing is, there's sort of a cross-subsidization of capital from a healthier bank to a weaker bank, and that is what is effectively happening. But some of the benefits may come, from basically the Dena Bank sort of getting over the, getting out of PCA, because now it has reasonably adequate capital to be able to start doing lending activities.
Sure. On the stock markets today, I'm not asking you for a reaction on the stock price or anything, but Bank of Baroda sold off by 12%. Obviously, investors are worried that a bank which was in the process of cleaning up, had a clear roadmap, will now have to, in some ways, start close to scratch again. That's going to be a problem with a lot of these mergers. Should they happen in the next, 12, 24 months, there'll always be a weak bank being foisted upon on a strong bank.
I agree. And, I just before this show, I sent an email to my students. I'm teaching them mergers and acquisitions. And the last class that we just finished, that if the acquisition is not necessarily a good one for the acquirer, which is in this case primarily Bank of Baroda, stock markets, in the short run will sort of, give that verdict. And today's sort of, significant drop in the, Bank of Baroda stock price is consistent with that. But, this is a short-term response, which is not factoring in some of the potential benefits that can be realized I think the market is also being, sort of pessimistic, because we know that, based on prior evidence, mergers that are sort of, foisted from the top typically don't do that well. And so I think the response is consistent with expectations, which is that it is something which is actually makes the Bank of Baroda shareholders lose, while clearly the Dena Bank shareholders gain definitely. And that's why Dena Bank stock price has risen by about 20-odd%.
It's interesting that all of this is playing out in classrooms and in reality. Your students are probably lucky. On Bank of Baroda, how much do they stand to benefit from the increased scale, in the sense that, a lot is being said about this now being the third largest bank. Bank of Baroda has never actually taken on an SBI in large corporate lending, etc. They've done their own thing in some ways. Does this scale now allow them to become a big player in the big ticket loans, you think?
I would say that I think the bigger gain potentially might be on the retail side. As I had mentioned earlier, that Bank of Baroda has a very significant presence in retail, right? A large part of its lending book is retail, and therefore now that you have basically, you get presence in the south of India, because of the branches of Vijaya Bank, and then you also have considerable more presence in the western part of India because of Dena Bank. I think that may be, if I were basically the Bank of Baroda management, or let's say on the board, I would think that this would be an opportunity to try and exploit. You'd be really sort of create significantly more retail presence. We also remember that typically NPAs in retail lending tend to be lower. In phenomenon of sort of large willful defaults, etc., do not happen as much. So I mean, I would look at this as an opportunity for Bank of Baroda to really expand its retail presence, and which play to its strengths rather than trying to actually alleviate its weaknesses.
All right, so a couple of last questions, more on the theoretical aspects of the Indian banking sector. Through all of your research and all of your writings, do you conceptually think that this is eventually the direction one needs to move in, to have about 4 or 5 banks, either the size of SBI or somewhere in that region? And then the smaller ones, I'm not sure whether they play a regional role or, market-specific roles. Is that the broad structure you think we should move towards?
No, I'm not quite sure about it. Let's sort of just as a benchmarking exercise, let's just consider some numbers, right? We are a population of about 1.3 billion now, 1.31, closing in on 1.4 billion. Just to take as a benchmark, the United States, which has a population of a third, less than a third, 400 million, has about 25,000 banks, right? And we have about, sort of, even if you include UCBs, etc., we clearly orders of magnitude lower, and that does show up in the level of competition, among banks. So in general, I have been of the view that our banks have not sort of learned that well to be able to come up with new products, compete on products. They tend to make profits from the fact that it's sort of more or less an oligopolistic structure. So I am not quite sure that that the lesser number of banks is generally a better thing. We really need, given the amount of the large percentage of population that still gets deprived of credit, on the one hand, and on the other hand, you have all these public sector banks, investing close to, in excess of 40% in Government of India securities, when the SLR requirements is still about, in about 20-odd%, which means there is, so much money that still can be lent, but these banks have not figured out the model to be able to reach out to customers, basically those who don't have that good a track record. So, and that to me is actually a manifestation of the lack of adequate competition in the banking sector. So I, would think that there should be more competition, and what the Reserve Bank had started doing was giving out these licenses for small banks and payment banks, which I think was a move in the right direction. So I think some of this consolidation, which clearly is forced upon because of the distress of some of these smaller banks, is something which actually sort of blocks that move towards greater competition in the banking sector. I think that if you look at it in a 20-year horizon, I would think that we certainly need a lot more banks that actually should be competing amongst each other, and thereby providing greater value to the consumers, and providing more loans, reducing the amount of credit rationing that you see in the economy, which is about the people people who basically, large percentage of the population that still don't get credit and other financial services.
That's very interesting. So then what would be your preferred policy, prescription, for the want of a better word, for these banks, these public sector banks, assuming that there's no privatization on the agenda right now? You're in favor of what the government putting in money?
No, I think this is, I'll have to give a sort of a reasonably longish answer to this, because this is what we had written in the PJ committee. And, I must remind our viewers that, in May 2014, when we had submitted the report, we had actually at that time predicted that at a minimum, our public sector banks will need about 2.2 lakh crores of capital, and, which many people, particularly in the, some people in the government had said, oh, this is too alarmist. And as you see, the actual numbers of recapitalization is almost exactly the same number. Now, what is important is we also said that that money that the government has to put in would basically not generate a good return on investment unless the governance reforms that we had recommended in the report, unless they are pushed through. And I actually have been quite disappointed by by the pace of that. I do not think those governance reforms, which really. So we had identified the umbilical cord that connects the Ministry of Finance with the, with the public sector banks, to the extent that, now if you step into a public sector bank branch, you have to get out and read the, the name on the board to know which bank you are banking with. Each of them is really like a clone of the other. In contrast, if you look at private sector banks, you have a Kotak that actually has a different DNA from, let's say, a Yes Bank or an ICICI or an HDFC. But all these banks, public sector banks, have become clones of each other, which has to do with the kind of, the umbilical cord and the bureaucratic influence that basically permeates these public sector banks. So we had, talked about, of course, not about privatization, but sort of some of these governance problems that we had identified, creating a bank holding company, transferring those stakes, making sure that the boards of these public sector banks are populated with good people, that these banks are converted into corporations. As it turns out, they all basically, none of them is a company right now, right? Because they derive their existence from the Banking Regulation Act and the Bank Nationalization Act, none of which has been done. So I think a lot of the agenda for reform in the governance sector still remains. We are putting money in the hope that, what we had done in the past, we basically would, those same mistakes will not give different outcomes. And as Albert Einstein had said, if you keep doing the same thing and you expect different outcomes, I don't think that makes a lot of sense.
No, absolutely. And I have to say that PJ committee report was quite prescient. The number of times we go back to recommendations made in that report, unfortunately not implemented, is quite a large number. But it's been...
Yes, and I must mention actually that, some of the reforms in the Indradhanush, actually, whether it's for the Bank Boards Bureau, etc., it appears as if basically it's been implemented, but those were implemented really in letter, not in spirit. The spirit is what actually is lacking. And so, the government really needs to sort of nail some of these governance issues. And otherwise, we might have, once again, the economy might actually start doing well. Our bankers will get into irrational, exuberant mood. Sort of the seeds for the next crisis will be sown during good times. And we'll be talking about the same set of issues another 10 years from now, when there's a nosedive in the economy again.
Hopefully not. But this was a fabulous discussion. Thank you so much, Professor Subramanian, for stopping by. Great chatting with you about the banking sector. As he said, there are much larger issues there. Consolidation, one story, but it has to play along with a large number of stories, particularly governance reforms. Thanks for watching Bloomberg Quint.